Thanks for joining us for the executive series today. I'm speaking with Andrew Schwartz, who is the CEO of Qualitas. Andrew, Qualitas is an interesting organisation because it straddles an intersection that includes the equity market, it includes debt markets, and it also includes the property market as well. For people who aren't familiar with Qualitas, tell us a little bit more about the organisation.
Yeah, thanks, Tom, and pleasure to be here. Thank you for having me. We're an alternative investment real estate manager. We manage $9.2 billion of assets under management. Primarily, we're focused on real estate private credit, so that comprises $7.5 billion of our total assets, and we have $1.7 billion of real estate equity under management. So that's our prime focus.
When you say alternative, how do you define that?
I define it as alternative to mainstream banks. So people think about commercial real estate debt, particularly in Australia, as an industry that is really provided for by the four major trading banks in particular, and ADIs more generally. And I think of alternative is alternative to those ADIs and the major banks, dealing in private credit, so dealing in non-bank related capital.
So that is an important landscape to define from a risk perspective, for example, because the bank lenders have very strict boxes that they need to have ticked, I suppose. How is risk seen through your lens when you're investing in projects, for example?
Yeah, I'd say we're really micro on risk. And one of the most important things to remember about a group like Qualitas is we're not a bank. We're a fund manager, and 81% of all of our capital is institutional capital. So really dealing with sovereign wealth funds, pension funds, and superannuation fund type capital. And so we're really running under mandates, and those mandates, each of them will have differing risk and return requirements. And so each one of those you're looking at through the lens of the very specific mandate that you have. Now, one of our mandates is we run Qualitas itself is listed, the manager of the firm, but we also run a listed real estate credit fund known as the Qualitas Real Estate Income Fund. Ticker code is QRI. Now, that was set up in 2019 with quite a conservative mandate. It's basically about capital preservation, income certainty, pays monthly, regular returns to investors. Now, that's obviously a very conservative strategy. And through the lens of running a conservative strategy like that, we're very much bank-like in terms of our processes. I think that there's a couple of ways that one can perform the role of manager when you're looking at it through the lens of credit. And one of those is what I call a more finance-based approach, which is, have I got the right LVRs, tick, interest cover ratio, tick, borrower guarantees, tick. But the other way is really through the lens of more a property-based focus. Now, we're pure real estate, so we consider ourselves deep dive in that regard. And so we're really focused on what's the location of the property, what's it currently zoned. If we're doing an apartment construction loan, which is a really large part of our business, then we'll literally put up floor plans of each of the various apartments, look at hallways, where the bedrooms are located, what orientation, is it, northeast or southwest facing type orientation. And so really overlaying not just a banker's financial approach, but really bringing in a real estate focus to it as well.
So that's forensic examination of the projects that you invest in, which is important. But then I suppose, tell me more about the private credit side of things. This is, I suppose, where you turbocharge things a little bit in terms of the drivers of private credit at the moment.
Yeah, it depends on what you mean by turbocharge. I would say, again, you have to differentiate between a real estate credit fund manager versus a bank. Banks typically lever their balance sheets 9 to 10 times. They enjoy the benefit of government guarantees in respect of their deposit holders. They have retail deposit holders. If you flip to a firm like Qualitas, we're predominantly in equity capitalised funds with institutional capital, and we're not leveraging, by definition, we're not leveraging those funds. And so I would say we're probably less turbocharged because of the fact that we're dealing in equity capitalised funds versus a bank that I would say is more turbocharging their balance sheets by having 9-10 times leverage in their balance sheets. I think that, and this maybe, Tom, is the question you're asking me, is are you winning clientele because of the type of borrowers, because of the type of lending that you're actually doing? And I would say I think that we're offering more compelling product by way of really understanding what the needs of the fundamental borrower may be, and providing them a solution that delivers better equity returns for their equity relative to, say, what a more traditional bank could actually provide. And that's our main competitive advantage.
Yeah, that's exactly what I was meaning in terms of being able to access those private credit lenders that make a big impact on the ultimate return. But I suppose when you are talking about credit and property outside of the auspices of a bank environment, perhaps investors who aren't familiar with that landscape, they think, okay, that can be a troublesome combination.
Yeah.
How do you respond to those types of questions?
I think there are certain myths about the industry. One of those myths is, don't you guys deal with all the dodgy borrowers out there that can't otherwise go to a bank? Don't you go and provide more leverage to the borrowers? Isn't that how you're winning market share? And I think they are misunderstandings. They're myths of the industry. Like we deal with exactly the same borrowers that the banks deal with, right? Yeah. They're private mid-market borrowers who, if we're doing construction lending, which I'd say Qualitas, would perhaps be the largest construction lender in Australia outside the major banks. If we're not, we're in the top 2 or 3. But I think we're either way, we're right up there. And I would say what we're able to do is provide a more compelling solution to those borrowers, because we're able to provide perhaps slightly more loan to value than what a traditional bank could provide. And we can also deliver larger check sizes. The regulator focuses very carefully on the banks, and therefore check size, the volume of capital you can move, can be quite an issue for the banks, whereas a group like Qualitas, average loan size is $80 million. More than 65% of every loan we did in the last 12 months was more than $80 million. And typically we're writing literally $300 million check sizes to $600 or $700 million check sizes. We're currently working on a couple of transactions of circa $1 billion in a single check size. Now, whether we do that or not, time will tell. I don't want to overstate that point. But banks would have to syndicate those loans amongst themselves, whereas a group like ours has such deep mandates that we can spread it across our mandates and effectively provide a one solution to a borrower without the need for lots of people sitting around boardroom tables with lawyers or participating in loans. I think there's a new way of actually providing volume of capital to the debt market. That's the competitive advantage that Qualitas brings. And I think that, people saying, aren't you the mezzanine debt guys, or aren't you dealing with dodgy borrowers? I just think that's misunderstanding of the industry.
I suppose one thing that you aren't, limited to is your exposure to the mechanics of debt markets, and bond yields have been unusually volatile over the course of the last 12 months in particular. And there's a lot of disquiet about where they might be heading in the medium term. How do you view that as a risk in terms of your business?
Well, firstly, most of our portfolios are floating rate portfolios. So, at the moment, particularly with such volatility in interest rates, we tend not to provide fixed rate loans to our underlying borrowers. But I think that the issue of bond yields goes to that the large institutions who literally, may commit in excess of $1 billion of capital per institution to someone like Qualitas, what's their opportunity cost of investing in a real estate credit strategy versus a liquid credit strategy out of, say, the United States, where you're getting better returns because of volatility in the bond rates. And that is a factor. And we are on a global stage competing for capital. Sometimes when I'm traveling, I feel like an ambassador for Australia, singing, for our supper in this country. But what we've got going for us is a number of things. One is the housing market in Australia, which I'd be happy to talk to you more about. But in terms of price,
chronically underbuilt,
undersupplied, great stability, shown decades of price rises. The whole immigration story, which if you wanted to dig deeper into, I'd be happy to go into. But, in a way, Australia is geographically remote. One might even say, on a global stage, somewhat irrelevant. And I'm Australian, so I'm not trying to put my own country down. But what it does mean is that we're off that global geopolitical stage. And at the moment, you've got a lot of that same international capital that is watching the volatility in bond rates, but also tariffs and Liberation Day and everything else, saying, look, our risk premiums for the United States has gone up. And whereas I think Australia was previously on the back burner, in the last few weeks, people have said to me, you are definitely now on the front burner. And people...
As a haven.
As a haven, right? As a shelter for if things go wrong in the US, where are you going to have your money that is outside of geopolitics, is outside of Trump economics, where you can buy into an uncorrelated story relative to what's going on in the US. And then when you start to introduce housing, shortages, immigration, long-term price growth, you are on the right side of interest rate cycles. You've got CIO's ears going, actually, this is a good shelter for us in the event that, there was a downturn in the United States. So I don't wish bad things on people at all, but I think that situation is actually working to the Australian advantage at the moment.
And so how do you specifically dovetail that big picture into Qualitas's strategy?
Well, firstly, most of our capital comes from offshore. So we have large Asian investors, European investors, North American investors as well. I think it's about 65% of our total capital is offshore based. And I think that we literally play into the thematic of our geographical remoteness and price stability. And then we start to overlay it with the behaviour of the traditional financiers in Australia. Because, Tom, in Australia, the banks have done an amazing, great job for, I'm going to say, at least a century, and, control 80+% of the total commercial real estate debt market. That's actually a really unusual number. If you go to the UK and the US, in the US, the banks are 30%. Yep. In the UK and broader Europe, pan-Europe, it's about 50% of bank participation. If I go back 10 years in Australia, the banks were over 90% of total participation in the commercial real estate debt market. We define the debt market, the addressable market, as about a $500 billion market. So every 1% that the banks give up, by definition, means $5 billion of fresh capital has to be found. And the market grows because Australia's population's growing. We need more built form, whether that be houses, hospitals, schools, built infrastructure. So the market grows between 4 and 8% per annum as well. It's doubled in the last 10 years. So that's an enormous amount of debt capital that needs to come in that the banks can't provide. So when you overlay the fact that a lot of these global investors are very active in the United States and Europe and UK, and they've seen the lowering dominance of traditional banks in those markets, there's a lot for them to feel really excited about, specific to Australia. And we are riding multiple tailwinds in this country, and the international investors all fully understand the story that I just conveyed to you.
Andrew, sadly we're out of time. We could go on for a lot longer, but thanks very much for that illuminating chat about Qualitas.
Absolute pleasure. Thanks for having me.
And thanks for joining us for the Executive Series.